Tyler Crow, it's official. The bull market is here. We hit a new all-time high for the S&P 500 in January. That means a lot of people are just buying. They're just in it. That happens when the market's up. That momentum, people want to just continue riding the wave. Other investors are thinking it's time to sell. There's nothing out there. It's time to take the money and wait for the market to fall. We're going to go in a different direction, though, because, yeah, the bull market is here, but there are still cheap stocks out there to buy.
There's always a pocket of value somewhere. And now, if you're doing it right, you're probably selling something at a high price and buying something at a low price.
I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas than the two cheap stocks we're going to talk about right now, please go to our special link. You see it right there on the screen. It's fool.com/unscripted. We have a great partnership with The Motley Fool. The Motley Fool is going to give you its 10 best stocks to buy right now. Check out that link. Again, fool.com/unscripted. It's right there on the screen. Open a new tab, type it in, get it ready. When this video is done, click that link. Okay, Tyler, what's your stock? What's your cheap stock right now?
I might get a little eye roll from you because I think for the past like 6 or 7 years, I keep mentioning this one and you're like,
okay. All right, let me just go ahead and roll my eyes. What is it, Tyler?
Cleveland Cliffs. For those of you who do not know, Cleveland Cliffs is the largest steel maker in the United States now. They weren't that beforehand, but through a series of timely acquisitions, they're now the largest steel manufacturer in the United States. As of right now, if I were to tell you, hey, this is a cheap stock, and then you ask, hey, what's it priced at? And I said, oh, it's 30 times earnings. You'd go, that's not cheap. What are you doing? What if I said it was 6 times free cash flow? Now we're talking, right?
Yeah,
now
exactly.
We're talking.
I will say this too. I will say this, and you're going to explain why that is the case. But I want to say this, even if you're not interested in owning an integrated iron and steel company, I will tell you this, follow this company if for no other reason than the entertainment that is Lourenco Goncalves, the CEO.
Yes, he insults somebody on every single conference call in a very weird way. And I think
it's not unintentional. It's not unintentional.
No, I think this year's insult was for the recent deal that Nippon Steel is going to acquire United States Steel. So he decided to fire off on that one today. So always a little bit of extra entertainment when you're following those conference calls. Here's what attracts Cleveland Cliffs to me in particular. We had done a video previously on Nucor, and you had mentioned all the upstream things that it had done to secure its supply. Cleveland Cliffs is the only steelmaker in the United States that it 100% supplies its own raw materials. So it has the iron ore mines that it needs for the raw product for its steel facilities. It also owns a considerable portion of the steel recycling and scrap steel dealer businesses in the United States. I think they own 15% of the scrap steel market in the United States today. And they're making, with its blast furnaces, they're also making investments in an electric arc furnace or two, as well as some really cool and innovative things in the steel industry, like replacing metallurgical coal with hydrogen as the way of transforming iron ore into steel as the reduction agent. It's a really cool and interesting process, and something that's could be a huge thing in terms of translating the staid steel industry, which is a huge CO2 emitter, into kind of a net zero sort of business. Where that goes, I don't know, but it seems really interesting. But at the same time, we have a business that, albeit cyclical, I'll admit that, has for a long time been drastically improving its balance sheet over the years. The head of this business in 2015, this business was on the brink of insolvency. And from that time, through very deft financial management, buying back debt when it was trading for huge discounts because everyone thought it was going to go bankrupt, finding very opportune times to invest in the industry when everyone is looking at it as garbage. It's a fascinating business to follow, and one, as I said, trading for 6 times free cash flow. I realize that a lot of their business is tied to the automotive market. It's, as of today, because of the acquisitions that it's made, I think it provides closer to 40 or 50% of total steel supplied to the automotive industry comes from Cleveland Cliffs in the United States. Automotive is a higher margin steel than you get like making, for example, like rebar or steel beams for construction or things like that. And as a result, has a little bit better pricing power than just selling to construction warehouses, steel dealers, things like that. And over the past 2 years, we've just seen price hike after price hike, and it's actually exerting price pressure and commanding price premiums than, like I said, commercial scrap dealers. It brings out a little bit of the cyclicality of business, and overall just has been a very good manufacturer, paying down debt, becoming a much more efficient company. And I think in the not too distant future, I could foresee them either restarting dividends or starting buybacks because, like I said, it's 6 times free cash flow. If you're pumping out a lot of cash, you should probably start using it to buy back at something that cheap.
Before I bring my stock up, I just want to bring up this chart and talk about Cleveland Cliffs. So Goncalves became the CEO, I believe it was August of 2014, roughly. If you go from that point, the stock price has not really done that great. But again, when he took over the business, there were substantial problems and the stock fell a tremendous amount as he implemented his turnaround. And there were a lot of things about the turnaround that he was doing that people didn't like at first, but really from the low point of when the business really began to fully turn around, we're talking about 13x in returns since the beginning of 2016. He has created enormous value in the business. So again, even with the stock price up substantially from that low point, it's cheap, like Tyler said. And as much as he can be a lot to deal with, he has been an immense value creator, and that is likely to continue. I'm going to go in a completely different direction, Tyler, which
what a surprise.
Probably surprise. Exactly. Not a surprise, but I'm going to talk about Etsy. Okay. So Etsy is a company that frankly, their growth has stalled. I'm going to bring up a slide from their November presentation. We're not going to get their full year results and their fourth quarter results for a few more weeks yet, but this is from their third quarter. Revenue was up about 7%. That was mostly on take rate. In other words, the percentage of sales that sellers on their platform get. Because if you look at GMS, which is gross merchandise sales, total revenue generated by its sellers was $3 billion, basically flat year over year. So basically increasing the take from their sellers. And that drove really good operating leverage, good adjusted EBITDA margin, very profitable, good cash flows. So you might be asking yourself, why are you going to talk about a company that doesn't look like it's really growing? A couple things I think are important. Number one, I think there are signs that the business has reached a certain level of sustainability and some level of modest growth. It's probably exceeding the most recent levels is reasonable going forward. That they've taken some steps that I think are going to make their platforms more attractive. They're selling off some of their assets. They went through a bit of an acquisition spree. They've pulled back from that. They're selling off some assets and they're really focusing on their core brands. And I think that's going to pay off over time. And I think investors that are willing to be patient are going to be really well rewarded for that patience. And you're able to pay a price right now that helps absorb some of the risk that they don't completely find the formula for growth going forward. I'm going to bring up a chart here comparing Etsy to a couple of companies that are big in commerce and e-commerce, but also social media. I'm going to share Meta Platforms because it's the social giant. Etsy it's a seller, but it's more of a social kind of the way that it feels and the way that it's structured. It's an internet-based business. So I think there's some value in comparing it to a Meta and also thinking about Amazon and Target a little bit here. So Etsy gets the dark blue kind of purpley color, trades for 14 times free cash flow. That's good value for these sorts of high cash efficiency business. Certainly cheaper than even Target, which trades for about 18 times free cash flow. Target is a great retailer. It's gone through a tough period that's trading for a reasonable valuation. You look at it from an operating cash flow perspective, and you see it's very cash efficient. It turns off almost 13.5 times operating cash flow, turns almost all of its operating cash into free cash flow, whereas Target, it's 7 times free cash flow or operating cash flow. What that means, Target's having to take a lot of its operating cash and reinvest it back into its business. So I think you put all of those things together, you think about the efficiency of its business, the moats that it's built as the place to go to find curated handmade items, the strength of their relationship with sellers, continues to add new sellers, more people continue to shop on the platform. I think you combine all of those aspects together. And I think Etsy is a bargain right now. I think you have to be a little bit patient. You have to let the story play out in terms of their refocusing on growing their core business. But I think at 14 times free cash flow, it's a great price to pay, and investors are going to be rewarded over the long term.